Okay, so let's talk a little bit more about the stock market because it continues to have some volatility and it still concerns people. So we'll talk about that a little bit more today. But before I do, I feel like I need to clarify uh, why I'm making these videos. So I've been in the finance industry for a very long time, going on 12 years, and I got my master's degree in economics because I'm a geek. Uh, but the reason that I started making these videos is because those two topics, which to me are highly, highly interconnected, and there's definitely causation between the two. But those two topics I've always been told are by everybody basically, is that it's unapproachable. It seems really complicated. It seems like you know it's not easy to understand, and so I wanted to make these videos to help people understand more about what these things are. The topics about economics and the topics about the finance world. And the reason that I want to explain this in more relatable terms for whoever's watching is because this is important information. We as adults should be concerned and aware about these things. They didn't teach us about this stuff in school unless you went into that subject matter. And I feel like it shouldn't seem like it's unapproachable. It shouldn't seem like that it's too complicated to try to understand, because these are things that affect you daily, and these are topics that will affect your future. If you look at investments, your retirement, that's going to affect your future. So these are important topics to discuss and to understand and to learn, because the better you understand something, the better you will, the more that you'll be involved with it, and the better you will manage it. So what I mean by that is, like, for instance, your investments. If you don't feel that you understand your investments, you are statistically not going to manage your accounts, because you don't want to have to deal with something that you have to that you feel uncertain about. And so this is why I'm doing these videos, so that people can better understand and have a better idea of these topics, so that they can better manage their investments. And the better you manage it, the more money you will have. So, so this is why I'm having these videos. You know, why I'm making them for you guys, so that you guys can take this information and apply it to your everyday life. So, with that, let's talk about um, the stock market a little bit more. So we've had big swings and volatility in the markets in the last week. So I already did a video last week about don't panic about it. And if you didn't panic, you saw the markets, starting to, recover from the big downward swing that we had last week. So when you hear the word volatility by the news outlets, do not think that that is just a big swing downward. Volatility is being referred to as, no, sorry, I didn't realize this was like going sideways. Volatility is referred to as big swings up and big swings up. Oh, sorry, big swings down and big swings up. I can talk tonight, I promise. So it's the up and down movements, but it's not just little ones, it's big ones. Or if there's a ton of frequent ones, then that's volatility. So you saw, last week it had big swings down. Earlier this week it had, some swings up. It went down again today a little bit. So it's going to have these up and down movements all the time. And again, this is a good thing to have happen. The markets have been in the longest bull run in history. It can't keep going at this pace. It needs to have a reprieve. Like I said last time, it needs a break, right? So this is what we're getting. But don't overanalyze and don't read too much into those indices that you're seeing, okay? The Dow Jones Index, the Dow Jones Industrial Average Index, the S&P 500, and the NASDAQ, okay? So you hear those three major indices in the news all the time. Don't overanalyze it. Don't read too much into it, because what you are really seeing when you are having, when they're reporting those numbers, you want to know the secret? All you're really seeing is people's reaction to data. The indices themselves do not hold any data. It is just reaction to data. And so what I mean by that is people are reading things or hearing things from the media, and then they're taking that information and trading on it. And so the indices themselves have no data that they are trading on. It's information from the news outlets, and then they're trading, and then the index is basically reflecting those trades. So when you have big swings up, it's just basically showing that people are feeling optimistic about the markets. If you have big swings down, it's just showing people are pessimistic about the markets. That's really all you're seeing. It's not some grand secret, but everyone thinks that there's all this information in it. No, there isn't. So let me tell you why there isn't. Because those indices, how they work and what they are. So we are not going to go super in depth into each of them. I will go into, just a quick overview of each of them. And I might in later videos go in depth into each of them a little more. But so what you're looking at, so the Dow Jones, okay, that's the one, that's the most famous one. It's the one everybody hears about. Okay, not my most favorite index, to be honest. And the reason for that is it only holds 30 stocks. So when you hear blue chip stocks, it's an old term. That is what they're referring to. It's the stocks that are listed on the Dow Jones. These are big corporations. These are, large capitalization companies. And so, and there's only 30 of them that are listed on that index. Now, that index can change, which companies within that list of 30. So like during the financial crisis or shortly thereafter, they kicked GM out. But so like for today, they had IBM that moved pretty largely. And this is part of the reason why I'm not a fan of the Dow Jones. So IBM moved largely by itself. And because of that, it influenced, in fact, it didn't influence, it moved the whole index because there's only 30 stocks. And so any one company moves large enough and it's gonna, have a pretty good impact on the Dow Jones, index. So now my most favorite index, S&P 500. Okay, that one has literally 500 stocks in it. And actually it holds some bonds too. But that's where the name the S&P Standard & Poor 500 comes from, because it literally has 500 holdings. Majority of these are domestic, and they go across the board. It's not just large companies, they're mid-sized companies, small companies, and in about every market sector you could imagine. So I prefer that as the gauger of the markets because it's more broad-based. So it really, I feel like, captures a better picture of really how the markets are moving in general. The NASDAQ. So the NASDAQ is what a lot of people view as like the tech index. So back in the 90s, a lot of the tech companies listed on the NASDAQ. Really, it's because NASDAQ went after them and asked them to list on there. And so they did, and then kind of this trend kept going along with it, and they came to be known as, the tech index. So it's not that they only have tech stocks, but they do have a lot of the tech stocks on there. Also, mutual funds trade on the NASDAQ index, and so that is a little bit important because your mutual funds, which are the vast majority of most people's investments in their 401ks and retirement accounts, that's part of the NASDAQ. So the mutual funds are listed on the NASDAQ. So these are how these indices move. Okay. Now, again, I'm not actually a fan of gauging the markets by NASDAQ or Dow Jones. Okay, the NASDAQ I'm not a fan of because they have the FANG stocks, which are FAANG. So Facebook, Amazon, Apple, Netflix, Google. Okay, so those companies, although there's not necessarily, causation between all of them, there is correlation between them. And if the FANG stocks are suffering in a day, you will see it on the NASDAQ. You will see the impact of that on the NASDAQ. So this is why I'm not necessarily a fan of those two indices as a gauger of the markets, but really the S&P 500. That's just my personal opinion. You guys, if you like the Dow Jones or you like the NASDAQ, that's great. I prefer the 500 just because it's nice and broad-based, and it gives, to me, a better gauger of what the markets are doing. But regardless of which one you like, don't overanalyze, don't read too much into those numbers. They're just a point of reference. That's all they are. But a lot of people put a lot of heavy emphasis on them. Again, what you're really seeing is people's reaction to data. You're not seeing anything else. They're hearing information or reading information. They're taking that, trying to process it, and then trading it. And if there's a lot of people trading on, the markets, it's going to show in those indices based on the stocks that are listed in those indices. So that's all you're seeing. That's the great secret, right? I mean, and people don't realize this. So don't overreact, okay, to all the information that you're hearing about the markets moving and all this stuff, because it's a lot of overhype. It is a lot of overhype. So don't get too caught up in that. And what people don't realize is that the information that is out in the media, okay, 97% of it is fluff. Only 3% of it is actually applicable to the markets. Okay, that is insane. That is insane. And the vast majority of people that are trading, like individual investors, the vast majority of individual investors that are trading, they don't know how to filter that data. So they're getting bombarded by fluff, and they're taking that information and they're trading on it. So you can imagine, again, how quickly this can, make the markets move. And I talked about also the algorithms from like robo-advisors that can also get triggered. And so there's a reason why the markets have been, really volatile, and it's just because we have these cycles where people misunderstand the information, or rather, they don't understand it at all. It's not that they misunderstood it; it's just that they don't understand it at all, and then they trade on this information. So now institutional investors are different. All they do is analyze the data. Sometimes they overanalyze it, but that's, they're better at realizing and filtering the information as to what's applicable and what's not. Whereas individual investors just are like, oh, more information, the better. It's actually not the case. If you don't have the correct information, just a whole bunch of wrong information or information that's fluff, not necessarily wrong information, but just fluff information, then it's not going to help you any. But people think, oh, well, more information is always better. Again, if you're getting a whole bunch of nothing, then you're just getting a whole bunch of nothing. So you're just getting fluff. So be careful about that when you are reading and hearing news about, this and that. Again, 97% of it is fluff. It doesn't apply to the markets. Only 3% of it actually does. So make sure you learn how to be a little bit more picky about the information that you're reading and you're hearing. So But really, that's what it comes down to. And we'll talk more about, um, you know, filtering the data and you know, like market timing. Don't do that. Okay, just don't. Statistically, you're going to lose. And the reason, one of the many reasons, is because for individual investors, by the time that they hear or read that information, even with the advent of the internet and for how fast information travels, by the time they've heard it, that information has already been traded on. So this is why it's, trying to market time, again, along with a whole host of other reasons, it's not going to work. And I'll actually do a video on that because I feel like that is something that people need to be aware of. So anyways, I hope this helped. And, if you guys have questions, again, these videos are designed to, help you guys better understand the information you're hearing and seeing. If you guys have questions, I want you to ask them. And if you don't want to, comment in the videos, feel free to go ahead and message me privately on Messenger, and I will be more than happy to answer you either through a video or, or just answering your question back via the Messenger. Of course, if I answer on the video, I will not be, putting your name out there. I'll just, of course, everything will be kept confidential. But that's just to let you guys, give you a way for you guys to contact me and ask me questions that you have. So hopefully this helped. Something that somebody did ask just recently was, okay, so when the markets are down, what happens to the money? Right? Like, where does it go? And I thought that was actually a really good question because people think that it actually goes somewhere. It literally vanishes into thin air. Okay, value disappears. And so the best way to kind of explain this really kind of abstract idea that money just disappears. Okay, and this actually comes from this analogy I'm stealing from John, and so you can thank him for this idea. So it's like the value of your house. Okay, the value of your house fluctuates. Even if you don't do anything to it, you don't make any upgrades, you don't do anything with it. You're just living in it. Okay, if the housing market goes up, your house value goes up. And if the housing market value goes down, your house value goes down without you doing anything. It just disappears. That's how the stock market also, their valuation also disappears. And it disappears because people are selling. Okay, so just kind of like the housing market, if people are not buying, then the housing prices get depressed. If the stock market, if people are selling, then the stock market prices get depressed. And so it vanishes in the sense into thin air without you doing anything. Even if you're not buying or selling, it fluctuates up and down based on how the overall market is performing. So, but I thought it was a great question when they said, "Now where does the money go? Like who has all this money?" Nobody has all this money. It just disappears in value. And so during the financial crisis, when the markets lost, I shouldn't laugh because it was really bad. But when it lost trillions of dollars, it literally evaporated, in some cases overnight, into thin air. So, and of course, that valuation came back. It took time, but that's where the money goes. It goes into thin air. So, but anyways, if you guys have any questions, let me know. I'm more than happy to answer them, and I will talk with you guys later.